How's it going, guys? I'm in the money. In December of 2022, I made a video talking about the macroeconomic situation at the time, which was not looking super good. Inflation was high, and the Federal Reserve and Jerome Powell were raising interest rates rather aggressively to try to tame inflation. I discussed how they were going to raise interest rates, hold them steady, and then decrease them once inflation had been tamed to mitigate any risk to the economy, because high interest rates is going to cause some ripples throughout the economy, make borrowing costs higher, make homes more expensive, etc. I also mentioned that you're going to see an increase in unemployment with such a high level of interest rates. It's just going to happen. The companies are going to start laying off employees to cut costs. So here's today. Here's the Fed funds rate. Here's inflation right there. We're sitting at 7.7%, right? That was the last reading of inflation. And unemployment is really, really low. It's at 3.3%. It will not stay that low. It will go up. So I mentioned those two things. And then I particularly mentioned the fact that there's a positive correlation between interest rates and the stock market. In other words, when interest rates are going up, so does the stock market. When interest rates go down, so does the stock market, which is kind of backwards because interest rates are not good for companies. It means higher borrowing costs. It means people are spending less money on their products and services. So where's that? Why are they correlated? Correlation does not mean causation. Usually there's a third variable, maybe there's a fourth variable. There's a lot going on sometimes. In this case, the third variable is typically the unemployment rate. In general, the economy, but particularly the unemployment rate, because when you hold the federal funds rate at a high target for long enough, you're going to see unemployment rise. And when unemployment rises, that's going to start spooking the stock market because companies are trying to cut costs to stay afloat. And so the stock market is going to decline. So you're going to see the fact that when the Fed is increasing interest rates, the stock market can rise just fine. In fact, if I share my screen here, you can see that when I released my video in December of 2022, which is right here, up to the top of the Qs, it was about a 92% return, so almost 100% return. But if we look down here at the Fed funds rate, right when I made that video, it's really, really high. And yet it was held at a high rate. And even though it was held at a high rate, the stock market continued to pump up really aggressively. Now, in that video that I'm talking about, I also mentioned very importantly that history tells us that when interest rates decline, the stock market declines. And why is that? It's because of that third variable. It's because when you hold the Fed funds rate at a high level, you're going to see unemployment rise. And when unemployment rises, then the Fed's going to be kicked into decreasing interest rates because they don't want the economy to be pushed into a recession. And the stock market is reacting to the bad jobs report or the bad economic outlook. So while the stock market's responding to that bad economic outlook, the Fed is going to start cutting rates to manage the economy and start stimulating it a little bit so it doesn't tip over into a recession. There's that correlation where the Fed pivot, where they go from being hawkish, increasing interest rates or holding them steady, to decreasing interest rates, being dovish. You're going to see that the stock market tends to decrease, which is really counterintuitive. But if we look back on the screen here, oh my gosh, you can see that if I scroll over to the side, it's a lot more drastic. This is 2020. Obviously, unemployment rose quite drastically in 2020 when everyone was kept indoors. But if I pull it to the side, you can see that it's a little bit more dramatic. The unemployment rate, while everything was booming, was really low. It was around 3%, 3.5%, 3%. But then we had a bad jobs report. You can see it's starting to tick up actually pretty aggressively. And it triggered something called the SOM rule, which is a rule. It's more of an economic observation where when this unemployment breaks a certain level at a certain velocity, it has always preceded a recession, and it has had 100% prediction, or it's preceded a recession 100% of the time as far as you look back, essentially. But you can see as the federal funds rate has been raised, inflation has cooled off, but unemployment is rising. And so when unemployment is rising, you're going to see fear in the stock market, even though the next cut for the Fed funds rate is going to be in September, which is right here. It's not that far away. The Fed is going to be starting to cut rates this year. But my point is, they might be behind the curve. because in July 30, on the 31st, they had an opportunity to cut interest rates, and yet they didn't. And we had this bad jobs report, and now we're having to wait until September at the earliest to see them cut their interest rates. So they're falling. It's possible they're falling behind the curve, and so you can see that what's going to happen is, let me switch over again, is that the Fed funds rate is going to start decreasing, and at the same time, hopefully inflation stays at a relatively cool level. Hopefully it doesn't increase again, because that would be a mess, because then they would have to increase the rates again to cool off inflation. So we'll hope that inflation stays at a relatively cool level. But you're going to see unemployment is going to keep going up because the Fed funds rate is lagging. Its effects are lagging. That's why they couldn't see this coming, is because economic data lags. The effect of the federal funds rate on the economy, on companies, is lagging. And so the data that they have to work with is lagging, and the tools that they have to manage the economy are blunt. And so you're going to see unemployment continue to rise, and that's what this fear right here is all about. We've had this drop of what? About, I'm really eyeballing it here, about 15%. I'm just saying that we haven't even seen the Fed cut rates yet. And historically, when the Fed cuts rates, you'll see the stock market decline. We can just look back. Let's go back to 2000, and we can see the exact same thing. Here's the Fed funds rate. It's really high at 2000, around 2000. And then it goes down. And as it's going down, you can see that the stock market declines with it. If we go to 2008, the Fed funds rate is really high, right? And then it goes down. And at the same time, you can see the stock market goes down with it. If we go even further back, which I would have to do, I can't even go further back on the cues, but back in the 1980s, it's the exact same story. So why should it be any different this time, is my question. We're going to see unemployment continue to rise, and we're going to see the Fed start cutting rates to mitigate that. Hopefully, inflation does not pop off, but it shows that there's a potential for the stock market to continue downwards. However, when you see the stock market continue downwards, especially in a recession, it does a lot of this, right? So it makes it hard to time the exact bottom. Like, where's the bottom going to be? Because there's these massive rallies in between these bottoms. So it's hard to time the bottom. So what can you do to mitigate against this potential risk? This potential risk that the Fed has fallen behind the curve, and they're just trying to catch up by cutting interest rates, but it might be too late and we might be pushed into a recession. Well, one thing you can do is hold on to your butt and just ride it out. That's totally fine, especially if you don't have any money on the side or whatever that you can't throw into it. Number two, don't sell. Unless you are buying penny stocks, don't sell. Make sure you're, appropriately allocated to stocks and ETFs or whatever. Don't be all into like Chegg or something, or Snapchat. But if you're generally well allocated, don't sell. You can dollar cost average, continue to buy on the way down, or you can do what I'm doing, which I'm in a unique situation where I don't have a lot of money. I've been sick for 3 years, not really making videos, which is my main source of income, and a ton of money has gone to medical bills. One of my medical bills alone was around $40,000 because I had to pay out of pocket for med that didn't work, or worked slightly, but it was really expensive. So I don't have the money I have right now is money I need to live. So what I have is my Roth, and my Roth is you can see it in my Patreon. If you want to join my Patreon, it's only $10 a month, and you can see whatever I do. It's in the description below in the link tree, and you'll see it at the end of this video. But what I'm doing is I'm trying to be patient, and I'm waiting until I feel like the stock market has declined enough to where I can take my positions and put them into leap options, which are options that are call options in particular that are deep in the money and have an expiration far out in the future. So what I'm essentially doing is, well, I've sold my Robinhood profits of 100%, thrown them in QQQ. I've taken some of my leaps before the bad job market report and I threw them to QQQ, which I'm glad I did because they would be down pretty big. And so I have a ton of money in QQQ and some other stocks. And what I'm going to do is, as this goes down, once it hits probably minus 30%, we'll have to see. There's a possibility I miss the bottom. It's a little tricky because I'm trying to time the market, and we all know timing the market is not really that easy. But what I'm trying to do is wait until things have dropped substantially and then take the money from QQQ and buy leaps on QQQ so that I leverage myself as things go up. And this might be a great opportunity, especially if we get pushed into a recession. Even Jerome Powell has said in the past that some person asked him if it was possible that we could go through this and not be pushed into a recession. And Jerome Powell said, yeah, it could be a soft-ish landing and not a severe recession. So even back, that was, I don't know, 6 months ago or whatever, he was still talking in terms where it didn't sound like he was fully confident that we could avoid a recession entirely. So I'm waiting for things to dip substantially, and then I'll buy a bunch of leaps and leverage myself to the tits. In fact, I'll probably break my rule where I say you should put only 10% of your portfolio into leaps, and I'll break my rule and probably put more like 30 to 50% into leap options on QQQ. That means I have to get kind of lucky and buy somewhat near the bottom. It's okay if I don't buy exactly at the bottom because these leaps expire in 2 years. And as the stock market recoups from, even if I buy here and it drops another 10%, if it recoups and goes above my break even by expiration anyway, I will make money. So that's why leaps are great, because you don't need to make money fast. I can buy them 2 years out. I have 2 years for things to recover, and like the average recession time is like a year and a half or whatever. What is the average recession time? Let's ask Chat GPT. 17.5 months, so about a year and a half. So if I'm buying options that expire in 2 years and I've bought when things have dipped at least 30%, then I have a pretty good odds of making quite a bit of money as things rebound. If I were not in the situation where I'm kind of strapped for cash, I would just probably dollar cost average and then buy a couple leap options as things decline and maybe sell some calls against those leap options. But since I don't have that privilege, um, I do have the privilege of having a large Roth and having made good returns. But since I don't have that privilege of having money to dollar cost average, I'm going to try to leverage the absolute shit out of my portfolio when things tank. Now, will things tank for sure? Anything could happen. It could go down and just V-shaped recovery, and I can miss the whole thing. But if I miss the whole thing, it's okay because I'm already in equities. So I'll just ride the thing down or ride it right back up, and it'll be totally fine. The real risk is not waiting too long, because if I wait too long, it's fine. I'll buy leaps or I'll just continue to hold equities. The real risk comes with buying too early. Okay. You want to be, you can be a little bit early, you can be a little bit late, but if you're too early and you have to ride the year and a half recession all the way down while you're holding, 50% of your portfolio in leaps, then you're going to be really eating shit. And so it's a risky strategy, but it's a kind of I wouldn't say a once in a lifetime opportunity, but it's an opportunity that does not come around very often. So I'm being extremely patient and just holding my equities, holding my stocks, holding my QQQ ETF, and I'm just waiting, because as they try to start cutting rates, it's likely that in my opinion, it's likely that it might be a little bit too late, and we'll see that the jobs market does not perform well, and the economy does not look great, and the stock market's going to react to that by declining in value. Will that happen for sure? I don't know. But that's what I think is going to happen. And so I'm acting on what I think is going to happen. You should act on what you think is going to happen. And you should not probably do what I'm planning on doing. But I just wanted to share my ideas. So we be patient, we wait, and I think the best thing you could do in general for the average person is dollar cost average. Just buy as things go down. Right now, things are at a great discount. Keep buying as things go down. Take 10% of your paycheck and just throw it into SPY or QQQ or into your favorite stocks or whatever as things go down. And don't use it as don't panic sell. We're not that type of people, okay? So what I plan on doing is relatively high risk. It even risks my reputation a little bit, but it just seems like a really great opportunity. And this is literally playing out exactly how I foresaw it in my 2022 analysis. And I actually did a write up on TradingView, which I'll link down below so you guys can read it. But you can see that this is in the 80s when Paul Volcker raised, the chairman of the Fed, Paul Volcker, raised interest rates really high. You can see that inflation went down, unemployment peaked. And it was only once unemployment had peaked and inflation had cooled off to around 3% that you see that the stock market has rebounded. But you can see that unemployment started rising a lot earlier on. And as it started rising, that's when the stock market started declining, even though the Fed funds rate was declining as well. So you can see that literally, like right where it starts declining in the stock market, the Fed funds rate is declining as well. So there's that positive correlation again. So I say, notice that as a result, unemployment, the bottom chart, began to rise. I'm looking right here. This had no positive impact on equities, contrary to what some might think, because it would indicate inflation was being taken care of. Instead, the U.S. entered a recession and equities continued to decline. It was only once the Fed stopped lowering rates, unemployment peaked, and inflation neared their target rate did equities bottom. So we're looking for unemployment to rise substantially. We're looking for a decline in equities. We're looking for inflation to hit their target of around 2%. And we're waiting for the rates to start being cut. Okay, because that means something's broken. They cut rates when stuff is broken. It's not because things are going well. They cut rates when things are not doing so great. In fact, if they had an emergency meeting like some speculated and cut rates, that would induce a lot of fear. Even though it's good for the economy, technically speaking, it would induce a lot of fear that the Fed would, that people would think that the Fed felt they were behind the curve. So we'll see how things pan out. But that's my plan. Is it kind of like a little bit loony? Yeah. But it could be a great opportunity. But please consider the other alternatives that I mentioned. Okay. Just because I'm an idiot doesn't mean you have to be, right? If you want to follow my trades, you can follow them on Patreon. You'll see the thing pop up here in just a second. Otherwise, this is In the Money, signing out. Peace.